Imagine two people start investing on the exact same day. Same amount of money, same starting salary, same access to the stock market. 20 years later, one of them has built real wealth. The other one has almost nothing to show for it. Here's the strange part. It wasn't the smarter one who won. It wasn't the one with the better job, or the higher IQ, or the finance degree. It was the one who did something incredibly boring for a very long time. And the one who lost? He probably made more smart decisions than the winner. He read more books. He watched more market news. He tried harder. If that sounds backwards, stay with me, because by the end of this video, you'll understand exactly why trying harder is often the reason people stay broke, and why the real secret to becoming a millionaire has almost nothing to do with intelligence, income, or luck. Most people believe becoming a millionaire requires one of three things: a high-paying job, a brilliant investment idea, or plain old luck. So they wait. They wait until they earn more before they start investing. They wait for the right stock, the right moment, the right amount of confidence. In their mind, wealth is something you achieve someday, once conditions are perfect. But here's the uncomfortable truth. Conditions are never perfect. And the people who become millionaires aren't the ones who waited for perfect conditions. They're the ones who started before they felt ready, and then simply didn't stop. Let's break down why that happens, using a story. Picture Sarah and Daniel, both 25 years old. Both just got their first real paycheck. Sarah decides to invest $200 every single month into a simple, diversified fund. She doesn't check it daily. She barely thinks about it. It's automatic, almost boring. Daniel wants to invest too, but he wants to do it right. He starts researching. He reads about which stocks are hot. He watches videos about the next big opportunity. He waits for a dip to buy in. Sometimes the market drops and he panics, so he pulls his money out to wait for it to stabilize. Sometimes the market is rising and he feels like he missed his chance, so he waits for a pullback that never comes. 10 years pass. Sarah, who barely paid attention, has a steadily growing account. Daniel, who paid very close attention, has jumped in and out so many times that his returns are barely above what he started with. The irony is brutal. Sarah did less thinking and ended up with more money. Daniel did more thinking and ended up with less. Why? Here's the financial concept hiding underneath this story, and it's simpler than you'd expect. Growing money isn't really about picking the perfect investment. It's about giving an okay investment enough time to compound. Compounding is just a fancy word for a very simple idea. Your money makes money, and then that new money starts making money too. It's slow at first, almost invisible, like a snowball rolling down a hill. In the beginning, it barely grows, but the longer that snowball keeps rolling, the faster it picks up size, until eventually it's massive. The problem is, humans are terrible at waiting for snowballs. We want to see results now. So when the snowball looks small and unimpressive in year 1, 2, or 3, we assume it's not working, and we go looking for something faster. That search for something faster is exactly what wrecks most people's wealth building. Because the moment you interrupt the snowball, roll it off course, or stop it entirely, you're not just pausing your growth. You're starting the whole slow beginning all over again. Daniel didn't fail because he made bad investments. He failed because he never let one investment run long enough to actually compound. Every time he jumped to something new, he reset his own snowball back to the top of the hill. Now, here's where it gets interesting, because this isn't really a math problem. It's a psychology problem. Our brains were not built for modern investing. They were built for survival thousands of years ago in a world where quick reactions kept you alive. If you saw danger, you didn't sit and analyze it patiently. You reacted immediately. That same wiring is still running in your brain today, except now it's pointed at your bank account instead of a predator in the bushes. When the market drops, your brain screams, "Danger, get out now," even though historically, markets have always recovered and grown over time. When you see a friend post about doubling their money on some exciting new investment, your brain screams, "Opportunity, don't miss out," even when that excitement is usually a warning sign, not a green light.
This is called loss aversion and fear of missing out, and together they form one of the most expensive psychological traps in personal finance. Losing money hurts almost twice as much, emotionally, as gaining the same amount feels good. So we make decisions based on avoiding short-term pain, instead of allowing long-term gain. That's why so many people buy high when excitement is at its peak and sell low when fear is at its peak. It feels logical in the moment. It feels responsible, even smart. But it is, almost every single time, the exact opposite of what builds wealth. The people who become millionaires aren't immune to these feelings. They feel the same fear and the same excitement everyone else does. The difference is they've trained themselves to keep investing anyway, on a steady schedule, regardless of how loud those feelings get.
There's a second reason most people never build real wealth, and it has nothing to do with the stock market at all. Think about what usually happens when someone gets a raise. Their salary goes up, and almost immediately, their spending quietly goes up right alongside it. A slightly nicer apartment, a slightly newer car, more takeout, more subscriptions, more upgrades that all feel small and justified in the moment. This is called lifestyle creep, and it's sneaky because none of these choices feel reckless individually. Nobody sits down and decides to stay poor on purpose. But collectively, this pattern means that no matter how much someone earns, they never actually get ahead because their spending keeps pace with their income, dollar for dollar. Meanwhile, someone earning less, but who protects a portion of every paycheck before lifestyle has the chance to expand into it, ends up with more real wealth than the higher earner, even though on paper, the higher earner looks far more successful. This is why you'll sometimes hear stories about a school teacher or a janitor who quietly left behind a multi-million-dollar estate. It wasn't a secret high income. It was decades of consistent, unspectacular investing, protected from a lifestyle that never got the chance to eat it alive.
So here's the idea underneath everything we've talked about. Building wealth isn't primarily a math skill. It's a behavior skill. It's not about finding the smartest strategy. It's about finding a reasonably good strategy and then having the emotional discipline to stick with it long enough for time to do the heavy lifting. Most people treat investing like a test they need to study hard for and get right on the first try. But investing behaves more like fitness. You don't need the perfect workout plan. You need a decent plan that you actually follow, consistently, for years, without quitting every time it feels boring or uncomfortable. The people who become millionaires through investing are rarely the ones with the highest IQ or the most exciting portfolio. They're the ones who figured out how to make investing automatic, boring, and nearly emotion-proof. They removed themselves from the decision as much as possible so that fear and excitement couldn't sabotage them at the worst possible moments. That's the real secret hiding behind almost every quiet millionaire story. Not genius, consistency.
So what does this mean for you, practically? First, stop searching for the perfect investment. A good, simple, diversified investment that you hold for 20 years will almost always outperform a perfect investment that you nervously jump in and out of. Second, automate your investing the same way your bills are automated. When money moves before you have the chance to feel anything about it, you remove the emotional trap entirely. You're no longer relying on willpower or motivation, which are unreliable. You're relying on a system, which isn't. Third, protect yourself from lifestyle creep. Every time your income increases,
Try increasing your investing amount before your spending has a chance to expand. Let your investments grow as fast as your paycheck instead of your expenses growing just as fast. And fourth, expect the boring years. There will be long stretches where your progress feels invisible, where the snowball still looks small, where it seems like nothing is happening. That feeling is not a sign of failure. It's simply what compounding looks like in its early stages, right before it becomes.
Here's the thought I want to leave you with. Most people don't fail to become millionaires because they lack money, intelligence, or opportunity. They fail because they were never taught that wealth building is supposed to feel slow and uneventful for a long time before it feels impressive. They quit right before the snowball was about to pick up real speed. So the question isn't whether you're smart enough or lucky enough or making enough money right now to build wealth. The real question is simpler than that. Can you do something boring, consistently, for a very long time, even when it doesn't feel like it's working? Because the people who can answer yes to that question are the ones who quietly become millionaires. Not because they beat the market, but because they never stopped feeding their snowball long enough to watch it grow.
If you enjoyed this video, subscribe to Ton Invests for more videos about money, freedom, and building real wealth in a world designed to keep people financially distracted.